gym.
Driving just 5 miles per hour slower than you usually do will save over 2 million gallons of gas a day and help keep America out of the red. Do your part. Drive smart.
Did you know that now even the smallest business can afford its own 800 number? Because AT&T has just invented an 800 service so affordable that for only $6 a month, you can have your own 800 number. And with AT&T's new 800 service, you can receive calls from inside and outside your home state, so you can serve your customers better and get new ones. So call 1-800-225-1223 today. AT&T 800 service works over your existing phone line. And if you sign up now, you'll receive up to 30 minutes of 800 calls free. Can your business afford to have an 800 number? For only $6 a month, can your business afford not to? AT&T's new 800 service. $6 a month, up to 30 minutes of 800 calls free. Call today. 1-800-225-1223. AT&T, the right choice.
This opening portion of Market Wrap is sponsored by The Travelers. You're better off under the umbrella.
Good afternoon, everybody. Welcome to the Thursday edition of Market Wrap. I'm Bill Griffith.
And I'm Neal Cavuto. Here's what's happening. Stocks finishing the day higher on the strength of futures-related program buying in advance of tomorrow's so-called triple witching, but profit-taking did take the blue chips well off their highs by the day's end. Let's look at the unofficial numbers from Wall Street and see where we ended the day. The industrials looking like they're up to the tune of almost 8 points at 3025.72. The transports advancing a little bit better than 6 at 1180.36. Utilities going really nowhere, down 2/3 of a point at 207.62. The advanced decline ratio on the big board looking about 8 to 6 or 4 to 3 positive. We had on the day 572 issues unchanged. Some of the other market averages, S&P 500 up about a half at 387 1/3. The American Stock Exchange Composite up 1 1/4 at 368.41. And the NASDAQ at 522 1/2, advancing better than 4 points on the day.
Well, the government tested the bond market's mettle this morning with a couple of rather bullish economic reports. And in fact, bonds did sell off a bit in early trade. But as has been the case several times this week, traders saw any dip in prices as a buying opportunity. And the market came right back, returning to the low yields we have seen this week. Didn't hurt either when the government announced the results of the one-year bill auction today, which produced the lowest average yield we have seen since way back in April of 1977. That yield out today at 5.26%. Now the only wild card is the latest money supply data, which will be out in less than 30 minutes. In the meantime, here's how the 30-year bond is trading at this hour in the cash market. Now down 1/32 at 102 9/30, and the yield holding steady at 7.92%. And it was these two somewhat positive reports on the economy that had sent bond prices lower earlier in the day. First, an increase in the nation's merchandise trade deficit for July. It was up a whopping 55.6% to $5.9 billion. Exports gained just 0.8%, reflecting slower demand due to faltering economies outside the U.S. That is bad for our economy, but there was a silver lining as well. Imports surged, gaining 6.2%. That was interpreted as a sign by some economists that consumer demand is picking up in this economy of ours. But Merrill Lynch's Donald Strassheim says the outlook for consumer spending is good, but not great.
Selling season is going to be only very so-so. I think we have a recovery on our hands, but it is slow and sluggish, not rapid and robust.
And the weekly jobless claims numbers seem to support that view, although economists caution that you cannot read too much into 1 week's number. 402,000 Americans filed new claims for benefits during the week ending September 7th. That is down 17,000 from the previous week. But don't forget, the week of September 7th had only 4 days due to the Labor Day holiday.
Okay, joining us now, as he does every Thursday at this time on Market Wrap, is Joseph Battipaglia. He is Director of Research over at Grontal & Company. And he joins us from our Wall Street Bureau. Hi, Joe.
Good afternoon, Neal.
Good to see you, sir. Let's get right to it here. All right, a pretty anemic kind of market response today to all the potentially improving economic signs. What do you make of it?
Well, two things, really. It's stagnation on the one hand and complacency on the other. The stagnation is the economy. The numbers continue to prove that. The complacency is that we have low rates and low inflation, so investors aren't quick to second-guess themselves on their investments. So the market sort of hangs up here, almost like a balloon tethered to the ground.
Yeah, but we've been discussing this here, and the argument seems to be, Joe, all right, say what you will about these numbers, but they do speak of an improvement. Not much of one, granted, but an improvement. Why aren't investors at least sensing that part of the equation and indeed putting their faith in equities?
Well, they are having their faith in the equities, and they're staying with their positions. They're buying stocks because they feel that lower rates eventually will get this economy moving again. Plus, they also have that very sweet taste of the 1980s, which was a dynamite growth decade. Job growth, income growth were all things that made that decade what it was. Neither condition is present today, and that reality is not set in because on the international scene, we've proved our might in Iraq, and the Russian coup and all that came with it show that democracy has a chance of sprouting overseas. And those are very strong positive for psyche, and that's what everybody's feeding off of right now.
Well, the psyche certainly doesn't look good, though, for the Dow Jones Industrials. If you listen to a lot of analysts, they worry about, obviously, the third quarter earnings, which could be particularly hard for many of the cyclically laden industrials. And they speak, if there's any hope, go broader, go to the NASDAQ, go look elsewhere. Is that your general opinion, that the Dow is a sort of had it?
Well, I think the best way to characterize it is that little wax and wane. Let's use 3,000 as the midpoint for some time to come, because there's a lot of gap to fill between the economy and its level and valuations and where they are. So in that context, then, what investors have to do is when they get to their price targets or they see that the company is not going to meet the goals, step aside, but then look elsewhere for your return, because you can do that. You've got 5,000 or so stocks to trade in with big capitalizations, a low interest rate environment. That makes it very dynamic for an equity investor, even though if you were an old index buyer on the S&P 500, you'd be twiddling your thumbs, perhaps well into 92.
Okay, well, twiddle about the junk bond market for a minute. I know this is a favorite purview of yours, and you've had...
I'll talk about it as long as you ask about it.
Okay. But let's get a sense of where we stand there. And I know you've been looking at selected issues. Could you mention some of them and where they stand?
Well, right now, we like Eastern Airlines Equipment Trust Certificates. You've got a liquidating situation where the planes are going to be leased or sold. We see a value probably 40% ahead of where the bonds trade today. The Southland Corporation has a variety of debt, but the 4.5% bond is very interesting because you can buy it in the mid-40s with a 10% current yield, which far outstrips money market rates, yet you have the upside to par, which gives you perhaps a 15% annualized return. And lastly, we just added a new one. Transworld Company, which is basically the canteen food service company and restaurant chains such as Hardee's and Denny's. Basic storyline there, it's a zero coupon bond for a couple of more years, then it starts paying 17%. We can buy that bond in the mid-50s. Our return is towards the 20% area on an annualized basis.
So Joe, you're not at all disappointed by some of the trends that we've been seeing lately, despite the improving economy of the still fairly high, roughly 8 to 9% failure rates on the part of many of these bonds, not the ones you mentioned, by the way.
Well, you have to watch them very carefully because we've always said these are quasi-equities. But you'll notice that rarely you'll see a name in the computer field or in the technology area or somewhere where foreign competition can come in and knock us right out of the box. We're looking for consistent companies that have basically shown in the last 12 months during recession that they've got the resilience and the cash flow to meet their debts. Because if we have slow growth, and they've done well in recession, they should do very well in slow growth and in a growth environment.
Joe, as always, real pleasure having you. Thank you very much. Joseph Battipaglia, Director of Research over at Grontal & Company.
Take a break now. When we come back, Ford Chairman Harold Poland looks back on a not-so-successful model year for the auto industry.
Okay, Dan Dorfman is back. We'll have the Dorfman Report in about 40 minutes. Stay with us.
More valuable than most, this umbrella. Those who carry the Travelers for business insurance carry a 127-year tradition of excellence, upheld by 35,000 employees dedicated to customer satisfaction. Chosen by